Welcome back to the Deep Dive. Today, we're doing something a bit different. We're stepping away from, the pure numbers, the spreadsheets, the stock charts.
Yeah, we're going deeper, right into the psychology of it all.
Exactly. We're really digging into the core ideas, the big lessons from that landmark book, The Psychology of Money.
It's such a key book, and our mission today really is to cut through all that technical stuff, the jargon,
Right.
and get to what actually matters, which is, honestly, that doing well with money, it has surprisingly little to do with how smart you are.
Or your education, even.
Exactly. Or even knowing all the financial details. It really comes down to how you behave. It's a soft skill. It's psychology.
Not physics or math.
Not at all. And the evidence for this, it's incredibly compelling when you look at it.
And the book jumps right into that, doesn't it?
Ah.
It sets up this amazing contrast between two completely different lives.
Oh, yeah. It's the perfect setup. Richard Fuscone versus Ronald Reed.
Right. On paper, you'd expect totally opposite outcomes, wouldn't you?
Yeah.
Let's start with Fuscone. Tell us about him.
Okay, so Richard Fuscone, highly educated guy, Harvard Business School, University of Chicago, really successful executive.
Like top tier. Made one of those 40 under 40 lists, right?
That's the one. He was the picture of, aggressive financial success, but he took on massive leverage, huge amounts of debt.
To buy that mansion.
That incredible mansion, yeah, 18,000 square feet. In Greenwich, Connecticut, get this, 11 bathrooms, 2 pools.
11 bathrooms.
Yeah.
That's just signaling. Pure and simple. The kind of success people think they have to show.
Totally. It's all about appearances. And maintaining that lifestyle, it required just colossal income. The upkeep alone was apparently over $90,000 a month.
90 grand a month just to keep the lights on and the pools clean.
Yeah. It's just, a huge ego driving those decisions.
And that reliance on debt, plus having all your money tied up in something illiquid like a giant house.
It's a house of cards, basically, built on sand. So when 2008 hit,
The financial crisis.
exactly, that leverage just became toxic. The assets turned into massive liabilities overnight. Fuscone wiped out completely.
Filed for bankruptcy.
Yep, bankruptcy. That enormous house was foreclosed, sold at auction for like a fraction of its supposed worth. Here's this super smart, highly educated finance guy, completely undone.
By his own behavior, his ego.
That's it. Now, contrast that with Ronald Reed.
Okay, let's hear about Ronald Reed, the complete opposite, right?
Totally. He was the definition of low-key. Humble. Worked as a gas station attendant for 25 years.
Fixing cars.
Fixing cars. Then he was a janitor at JCPenney for another 17 years. Sweeping floors.
Lived quietly.
Very quietly.
Yeah.
Small, modest house he bought for like $12,000 back when he was 38. Frugal was his middle name.
So totally unassuming life. But then
he passes away in 2014, aged 92, and suddenly the world finds out his net worth, over $8 million.
$8 million from fixing cars and sweeping floors. That's incredible.
It really is. Think about it. He was one of less than 4,000 people who died that year in the U.S. with that kind of net worth.
Wow. And what did he do with it?
Well, he left a couple million to his stepkids, but then over $6 million went to his local hospital and library.
That's amazing. So the big question is, how? How did he do it without the fancy salary?
Purely the soft skills he saved. Consistently. Whatever little he could put away, he did.
And invested it.
Invested it.
Yeah.
Mostly in just, boring blue chip stocks. Johnson & Johnson, Procter & Gamble. Nothing flashy.
And the key was?
He held them for decades. He just let compounding do its thing over the longest possible time. That was his secret.
So Fuscone proves brains aren't enough if the behavior's wrong.
And Reed proves patience and frugality can win even without a huge income.
It's a perfect setup for the whole book.
Yeah.
Okay, so if that behavior, the patience, the saving, the time is the real key, let's unpack that first big lesson. The kind of counterintuitive power of compounding in time.
Right. And we had to start by admitting, our brains are just not built for this. We think linearly, additive, but real financial growth, the powerful kind, it's exponential.
Multiplicative.
Exactly. And the analogy the book uses, which is brilliant, is the Ice Age.
Oh, I love this one. Because you automatically assume, right, that something huge, like an ice age, needs this massive, sudden, destructive force, like unbelievably cold winters year after year.
That's what feels logical, but it's not how it worked.
Yeah.
Based on Milankovitch's cycles and Kepin's work, ice ages don't start because winters get crazy cold.
They start because
Because the summers are just slightly cooler than usual. moderately cool summers.
Okay, why does that matter? A slightly cool summer.
Because if the summer is just a little bit cool, not all the snow from the previous winter melts away. There's a little bit left over.
Oh, okay. Like a base layer.
Exactly. And that leftover snow, even a thin layer, reflects more sunlight back into space, which means the next summer is likely to be even cooler.
Which leaves even more snow behind.
You got it. It starts compounding. A tiny, tiny change, a summer that's just a bit cooler repeated year after year after year. Eventually that leads to these immense continental ice sheets.
Not from one big catastrophic winter, but from hundreds of years of slightly cool summers.
Precisely. It's not the force, it's the persistence, the failure to reverse the trend.
And the link to money is.
It's identical.
Yeah.
If something compounds, if the gains from one period become the base for the next period's gains, even a tiny starting amount can grow into something astronomical, logic-defying almost.
But we're always looking for that huge dramatic event, the stock that goes up 1,000%, the ravenously cold winter.
When really it's the quiet, boring, cool summer of just consistent, uninterrupted growth over decades that builds almost all the real wealth.
Which brings us straight to Warren Buffett. Everyone studies his stock picks, his valuation methods.
Right, they focus on the skill.
Yeah.
But his real superpower, it's time.
How much of his wealth came later in life?
Get this, 99%. 99% of his net worth was accumulated after he turned 50.
99%. That's staggering.
It really is. And think about this thought experiment. If Buffett had earned the exact same amazing returns, but he'd only invested from, say, age 30 to age 60.
Instead of starting super young.
Right. His net worth wouldn't be $80-odd billion. It would be maybe $12 million.
12 million versus 80 billion. Just because of the shorter time frame.
Yeah. It shows that even genius-level skill doesn't mean much for compounding if you don't give it enough time. His real skill was starting investing seriously when he was like 10 years old,
10.
and then just staying in the game. For 3/4 of a century, that's the edge.
And that highlights that human flaw again, doesn't it? We just don't get exponential growth intuitively.
Not easily. Ask someone to add 8 plus 8 plus 8 plus 8, they get 32 instantly. Linear. Easy.
But ask them to multiply 8 times 8 times 8 times 8.
Their brain kind of freezes up for a second. It's not intuitive. So we're always looking for the quick fix, the complex strategy, the next hot sector.
Well, linear solution.
Because we miss the quiet power of that exponential curve just working away uninterrupted for decades and decades.
It's like we're seduced by complexity when simplicity and patience are what actually work.
Totally. So the big takeaway here really is patience, above almost everything else.
Someone joked the best investing book title would be Shut Up and Wait.
Yeah, exactly. It's about humility, discipline. Compounding needs time, which means it needs survival. You have to stay in the game.
You need longevity.
Longevity is the magic ingredient, and you get that by avoiding the big mistakes, the catastrophic errors that kick you out of the market entirely.
Okay, so avoiding mistakes, that leads us right into the next big theme, doesn't it? This whole tangle of luck, risk, and the stories we tell ourselves.
Absolutely. Luck and risk. They're like inseparable twins, the book argues. Forces completely outside your own effort that shape every single outcome.
You can't control everything.
Not even close. The world's just too complex.
Yeah.
Billions of people, infinite variables. So if you believe that good luck, external factors, can help you.
You have to accept that bad luck, risk, can hurt you just as much.
You have to respect both sides of that coin. You can't cherry pick.
And the book uses Bill Gates and Kent Evans to show just how powerful these forces can be.
It's a perfect, almost chilling example. Bill Gates had incredible luck. 1 in a million luck, maybe?
Attending Lakeside School.
Yeah. In 1968, it was one of the only high schools in the world that had a computer, a time-sharing terminal hooked up to a GE mainframe.
Which wasn't standard equipment back then.
Not at all. It was a total fluke. The school's Mothers Club raised the money for it. That access, that sheer luck of being in the right place at the right time, it was crucial for him.
And he had this friend there, Kent Evans. Equally smart, equally passionate about computers.
Exactly. They were dreaming up businesses together even back then. But Kent, he experienced the flip side, the 1 in a million risk.
He died young, didn't he?
Yeah, tragically. Died in a mountaineering accident before he even finished high school. He could easily have been a co-founder of Microsoft.
So the point isn't just the tragedy, it's that the same magnitude of random external force.
Worked in completely opposite directions on two very similar people. One got a huge tailwind from luck, the other got hit by a catastrophic headwind of risk.
Yet, when we look back at success stories, we tend to ignore the luck part, don't we? Why is that?
Well, it's messy, isn't it? Luck is hard to quantify, and let's be honest, pointing out someone else's luck can sound kind of mean or jealous.
Right. And if you attribute your own success purely to luck,
It feels a bit demoralizing. It undermines your hard work, your choices. So we prefer these neat narratives. Success comes from skill and effort. Failure comes from bad decisions.
makes for a cleaner story.
Much cleaner. But it's super misleading because it makes us misread history. We end up romanticizing behavior that was actually incredibly risky.
Like with the big industrialists, Vanderbilt, Rockefeller.
Exactly. Think about Cornelius Vanderbilt building his railroad empire. There's that famous story where his advisors worried they're breaking the law.
And Vanderbilt supposedly scoffs like, you can't run a railroad according to the laws of New York.
Right. And history books often frame that as, wow, what bold vision, what cunning. He saw beyond the rules.
But looked at differently.
Looked at through the lens of risk. It's borderline reckless. He was openly flaunting the law. John D. Rockefeller, too. Praised as a genius, but a judge literally called his company's practices no better than a common thief.
So these guys were operating right on the edge.
Absolutely. A slightly different judge, a different political climate, a minor shift in fortune, and they could have been ruined. Criminal charges, even. That line between bold visionary and reckless gambler is often incredibly thin, and you only see it clearly in hindsight.
Hindsight bias is powerful.
It really is. Even someone like Benjamin Graham, the father of value investing, the ultimate proponent of prudence.
He admitted his biggest win violated his own rules.
Yep. His massive stake in Geico, which made him incredibly wealthy. It broke all his rules about diversification. He basically said he couldn't tell if it was one brilliant decision or just one really lucky break.
Because they looked the same at the time.
They often do. So the really critical lesson here for you listening is maybe focus less on those extreme outliers, the billionaires, where luck almost certainly played a huge role.
And focus more on
Broad patterns, things that are more repeatable, more applicable to your own situation. Look for general principles of success and failure, not just the spectacular one-in-a-million stories. Don't chase the lightning strike.
chase the repeatable, not the spectacular. Okay, that feels like a good pivot point. If we shouldn't chase the extremes, that brings us to this internal battle.
Yeah.
The idea of enough and how social comparison messes us up.
Yes. This is huge because it shifts the question from how do I get more money to a much harder question, what is enough?
And the anchor for this is that amazing anecdote about Kurt Vonnegut and Joseph Heller.
Oh, it's classic. They're at this party, right? Hosted by some billionaire hedge fund guy.
Yeah.
And Vonnegut points out that this billionaire host probably made more money that day.
Then Joseph Heller made from his masterpiece Catch-22 in its entire lifetime.
Right, which is just mind-boggling. But Heller's reply, it's perfect.
He says, yes, but I have something he will never have.
Enough.
Enough. Such a simple word, but so powerful in this context.
It's maybe the most important word in finance psychology because failing to define and internalize your own enough is what drives people who already have immense wealth to do incredibly stupid, risky things.
Like Rajat Gupta.
Perfect example, former CEO of McKinsey, hugely successful, respected, self-made millionaire many times over. By 2008, he's worth something like $100 million.
$100 million. I mean, that's freedom. That's security for generations. That's enough, surely.
You'd think so.
Yeah.
Just conservatively, that's generating millions a year in income. He had power, prestige, everything. But he wanted more. Apparently, he felt sort of inadequate compared to the actual billionaires on the Goldman Sachs board where he sat. He felt he needed to be a billionaire too.
So that desire, that comparison.
Led him straight into insider trading. He tipped off a hedge fund manager about Buffett's big investment in Goldman during the crisis.
And he didn't even make that much from it, relative to his wealth.
Peanuts. Maybe $1 million or so. But for that, he risked everything. And he lost everything. Reputation, freedom, fortune, gone.
Because the goalpost just kept moving. That desire for just a little bit more.
It never stops if you let it, which is why Buffett says it's just foolish. Why risk what you have and need?
For something you don't have and don't need.
Exactly. The core problem is that our expectations tend to rise even faster than our income or wealth. You make more. You start comparing yourself to richer people. You move neighborhoods. You compare to wealthier neighbors. It's endless.
And the book illustrates brilliantly why that social comparison game is just unwinnable.
Totally unwinnable. The ceiling just goes up forever.
Like the baseball player example.
Yeah. A rookie player makes, say, $500,000 a year. Seems like a lot. But then he looks at the star teammate making $30 million.
All right.
But that $30 million player, he might look up at a top hedge fund manager who pulled in $400 million in a single year.
Wow.
And even that hedge fund manager, he's looking up at someone like Jeff Bezos, whose net worth once went up by like $24 billion in 1 year.
$24 billion. The gap is just astronomical.
It's infinite, essentially. You can never reach the top because there effectively is no top. So the only way to win that game
Is not to play.
Exactly. Like in Vegas, the only winning move is not to play. You have to define enough for yourself based on your own life and values, not by looking at others.
Because knowing when to stop the striving is what protects the truly valuable things.
That's the key insight. It protects the things money can help you get, but that you should never risk losing, no matter the potential upside. Your reputation, your freedom, your independence, your family, being loved. Knowing you have enough is the best way to keep those safe.
Okay, so getting money might involve risk and confidence, but keeping it requires something else entirely. Humility, caution, paranoia even. Let's get into that. Section 4, survival, paranoia, and the price of success.
Right. This is a crucial distinction. Getting money and keeping money. They are two totally different skills.
How so?
Well, getting money often takes risk, optimism, putting yourself out there, chasing opportunities, maybe even being aggressive.
Okay.
But keeping money, that requires the opposite almost. It requires humility, frugality, and a healthy dose of paranoia, a constant awareness that everything you've gained could disappear really fast.
And the cautionary tale here is Jesse Livermore.
The ultimate cautionary tale. Livermore was a trading legend, probably the greatest stock trader of his era in the 1929 crash.
When everyone else was wiped out.
He shorted the market, made the equivalent of over $3 billion, in like a day. Just an incredible feat.
So he was set for life, multiple times over.
Should have been. But that massive success, it made him overconfident. It wiped out any sense of fear, any paranoia, any need for a margin of safety.
He thought he could do it again.
Exactly. He started making bigger and bigger bets, trying to replicate that huge win. And within just 4 years, he'd lost it all. Everything. Ran up huge debts.
And ultimately?
Tragically, he took his own life. The book makes a sharp point. Lots of people were ruined by the market in 1929, like Abraham Jermansky, but Jesse Livermore ruined himself afterwards because he lost that ability to respect risk.
Wow. So survival isn't just passive, it's an active strategy. Because you need to survive to let compounding work.
That's the absolute bedrock. Compounding needs time, and time needs survival. It's why successful long-term firms, like Sequoia Capital that Michael Moritz talks about,
They operate with paranoia.
Yeah, he says their success comes from always being afraid of going out of business. They assume disaster is always lurking. Buffett survived, 14 recessions? Not just because he's a great stock picker, but because he never got wiped out. He always had cash. He never used much leverage. He never panic sold. He just survived.
So just staying solvent, staying in the game, is maybe the most underrated financial skill. But doing that means you have to accept the downsides, right? You have to pay the price.
Yes, and this is a huge psychological shift people need to make. Investing successfully has a price, but it's not paid in dollars and cents.
That's paid in.
Volatility, fear, doubt, uncertainty, regret, all those awful feelings you get when the market drops 20%, 30%, 50%. That's the price of admission for decent long-term returns.
But we don't see it that way, do we? When the market drops, it feels like a fine. Like we did something wrong, we're being punished.
Exactly. We feel fine, but we need to reframe it. Think of it like buying anything else valuable, say a $30,000 car. You can pay the sticker price, the $30,000. That's the accepted cost. Or you could try to steal the car.
Right. Obviously not a good idea.
Well, in investing, trying to steal the returns means trying to get the upside without paying the price of volatility, trying to time the market perfectly, jump out before every dip, jump back in right at the bottom.
Trying to avoid the fee.
Yeah. And what happens when you try to steal the returns, you almost always end up paying double.
How so?
Through underperformance, missing the best recovery days because you were scared on the sidelines, constantly churning your portfolio. Studies show time and again, investors who try to dodge the volatility end up doing worse than if they just bought and held. They pay a much bigger price in the end.
So that volatility, that gut-wrenching fear, that's the admission fee you have to pay to get into the compounding theater.
You have to view it that way. It's the cost of entry. Accept it, pay it, and stay for the show.
Okay, so to help us pay that fee, to help us survive the inevitable downturns, we need a buffer, a margin of safety.
Absolutely essential. And it often gets dismissed as too conservative, especially when markets are going up.
People think it's dead money, maybe.
Right. But it's not conservative, it's crucial insurance. A margin of safety is basically the gap between what you expect to happen and what could happen while still leaving you okay. Still able to fight another day.
It requires that weird mix of personality traits again.
The barbelled personality. You need to be optimistic enough about the long-term future to actually invest and stay invested, but also paranoid enough about the short-term risks to ensure you survive any potential disaster.
And this isn't just about diversifying stocks, right? It applies to holding cash, too.
Definitely. Holding cash, even when it's earning next to nothing, can feel irrational in a bull market. Why hold cash earning 1% when stocks are going up 15%?
It seems like a bad trade.
On the surface.
Mm.
But the real return on that cash isn't the interest rate. It's the flexibility it gives you. If a crisis hits, you lose your job, unexpected expense, and that cash means you don't have to sell your stocks at the worst possible moment.
Then the return on that cash is huge.
Immense.
Yeah.
Or if that cash lets you buy stocks when they're cheap and everyone else is panicking, the true return is incredible. It's survival capital. It buys you options.
So you have to plan not just for the risks you see coming, but the ones you can't even imagine, like the German tanks example.
Oh yeah, that's a great illustration. In World War II, some German tanks were apparently disabled not by enemy shells, but by field mice chewing through the wiring insulation.
Field mice. Nobody puts field mice in their risk assessment plan.
Exactly. You can't predict everything.
Hmm.
A margin of safety is your buffer against the financial equivalent of field mice. The totally unexpected, unthinkable risks. It ensures you don't have to make a desperate, life-altering decision in the middle of a crisis you didn't see coming.
That need for flexibility, for control, for options, that feels like the perfect lead-in to what money is actually for. If survival is the strategy, what's the goal? Section 5, the true dividends of wealth.
Right. Because we've established it's not really about the fancy stuff. The highest form of wealth isn't the Ferrari or the mansion. It's purely psychological.
It's control over your time.
That's it. The single biggest dividend money pays is the ability to wake up in the morning and say, I can do whatever I want today.
Which lines up perfectly with all that happiness research, doesn't it? Like Angus Campbell's findings.
Exactly. He found that having a strong sense of controlling your own life is a way more dependable predictor of happiness than, your salary or the size of your house. Objective conditions matter less than that feeling of autonomy.
And the book uses that investment banking internship story to illustrate this.
Yeah. Great pay, right? Intellectually challenging work, prestige, all that stuff.
But the hours were brutal.
Insane. 100 hours a week sometimes. And crucially, zero control over when you worked. Your time wasn't your own, and that lack of control, even with the high pay, made it miserable.
It triggers that psychological reaction. Reactance.
Reactance, yeah. That feeling you get when you feel like your freedom is being constrained or taken away. You push back, even subconsciously. Money's real superpower is its ability to buy you out of situations that trigger reactance.
It buys you freedom from being told what to do.
Exactly. Savings gives you options. Maybe you take a lower-paying job with more flexibility or meaning. Maybe you can afford to quit a job you hate without panicking about the next paycheck. Maybe you can take time off to think or wait for the right opportunity. That control, that autonomy, that's priceless. Way more valuable than any luxury good.
But that message runs completely counter to what society often tells us wealth looks like, with all the signaling and spending. Which brings us to that other great insight. Wealth is what you don't see.
Yeah, this is such a key distinction. Rich versus wealthy.
Rich is.
Rich is current income, high cash flow, and it's often signaled by visible spending, the expensive car, the designer clothes, the big house.
And wealthy is.
Wealthy is assets you haven't spent. It's savings, investments, money that's working for you, often invisibly. When you see someone driving a $300,000 Ferrari...
You only know one thing for sure about their finances.
Right. You know they have $300,000 less wealth than they did before they bought it, or $300,000 more debt. You see the spending, not the actual wealth.
But we still feel that pull to buy flashy things, don't we? To gain respect or admiration.
We do. But it's based on a paradox, a misunderstanding. We buy the fancy stuff hoping people will admire us.
But they usually admire the thing.
Exactly. The book tells that story about the valet parking the Ferrari. He wasn't thinking, wow, that driver's so cool. He was thinking, wow, I wish I could drive this car. He's admiring the object and mentally putting himself in the driver's seat.
So the driver doesn't actually get the admiration they were seeking.
Rarely. You know what gets more genuine respect and admiration in the long run? Humility, kindness, empathy. Not horsepower.
Which circles back to that blunt advice from Rihanna's financial advisor.
Ah, yeah, the brutal truth. If you spend money on things, you will end up with the things and not the money. Simple as that.
So building wealth isn't just about earning more.
It's much more about your savings rate, how much you don't spend. And that savings rate, the book argues, is basically the gap between your ego and your income.
The gap between ego and income. I like that. So to save more.
You have to increase your humility. Care less about what other people think. Care less about signaling status with stuff. People who build and keep wealth tend to have this ability to just not give a damn about keeping up with the Joneses. They widen that gap between their income and their ego-driven spending.
And you don't even need a specific goal for those savings, right? Saving just for the sake of saving is okay.
It's more than okay. It's powerful. Saving without a specific goal is like buying the best insurance policy in the world. It's saving for the surprises life will throw at you. It's saving for opportunities you can't yet foresee. It's saving purely for the freedom and flexibility it provides.
That buffer against the unknown.
Exactly. That unseen cash sitting there, even earning zero interest, is generating this huge invisible return in the form of options, control, and peace of mind. It lets you navigate life's inevitable bumps without making forced, desperate financial decisions.
Okay, we've covered behavior, time, risk, ego, control.
Yeah.
For the last section, let's look at the bigger picture, the traps of using history as a guide, and this idea of playing different games.
Right. Because we tend to lean on history a lot in finance, but we have to be careful. Finance isn't physics.
Electrons don't have memories or emotions.
Exactly. But investors do. People change. Societies change. Economies evolve. So history is useful, definitely. It helps us understand timeless patterns, greed, fear, cycles. It calibrates our expectations.
But it's not a perfect map of the future.
Not at all. Because the playing field itself changes. We fall into this historian as prophet trap, thinking if something worked before, it'll work exactly the same way again.
Like Benjamin Graham's old formulas.
Perfect example. Back in the mid-20th century, his strategy of buying stocks, trading for less than their net working capital, basically, super cheap, asset-heavy companies worked brilliantly.
But not so much anymore.
Largely no, because the economy's different. It's driven by intangible assets now. Software, brands, networks. Competition is global and fierce. Information moves instantly. The structural conditions that made his formula work just aren't the same.
So the lesson from history needs to be more general.
The further back you look, the more general your takeaway should be. Focus on the enduring human behaviors, not the specific tactics. And always remember that things that have never happened before happen all the time. The world is constantly surprising us.
And in this uncertain world, pessimism often sounds smarter, doesn't it? Doom and gloom gets more attention than steady optimism. Why is that?
Well, part of it is probably evolutionary, like you said earlier, loss aversion. Threats feel more urgent than opportunities. It helped us survive.
Makes sense.
But there's also a structural reason. Bad financial news tends to be sudden and universal.
Yeah.
A market crash, a recession, it affects almost everyone, everywhere, immediately. It grabs headlines.
Whereas good news.
Good news, progress, often happens slowly, incrementally. It compounds quietly over time, like that stat about heart disease deaths falling 70% since the 60s. That's incredible progress. But it happened gradually, so it doesn't feel as impactful or urgent as a sudden crisis.
Destruction is fast, construction is slow.
Exactly. So the pessimistic narrative always feels more recent, more tangible, maybe even smarter. It takes real mental effort to stay balanced, to be paranoid about risk, but still optimistic about long-term progress.
And navigating this means knowing what game you're playing and not getting distracted by others playing a different one.
This is so important, especially when you see bubbles forming. Think about the dot-com bubble or the housing crisis.
Yeah.
Often, those weren't just caused by long-term investors suddenly becoming irrational. A big part of it was short-term traders acting perfectly rationally for their game.
How do you mean?
Well, if you're just trying to flip a house in 6 months and you're confident prices will keep rising short-term, it makes perfect sense to buy, even if the long-term value seems crazy. You're not investing. You're trading momentum, playing hot potato.
Okay, I see. Different objectives.
Completely different games, different time horizons. The real damage happens when the long-term investors, people like you, maybe, trying to build wealth over decades, start taking their cues from the short-term traders.
On the lines get blurred.
Yes. If your investing time frame is 30 years, why on earth would you panic and sell because someone whose time frame is 30 days is getting nervous? It makes no sense.
So you have to be really clear about your own strategy, your own time horizon.
Crystal clear. Define your game. Are you a long-term passive investor betting on global growth? Are you a value investor? Are you something else? Know your game and then rigorously ignore the noise and actions of people playing a completely different game.
That clarity protects you from getting swept up in the madness.
It's your shield against self-sabotage.
Right.
It lets you treat volatility as the fee it is, stay invested for the long haul, and measure your success by your own yardstick of enough, not by comparing yourself to everyone else.
Okay, fantastic. Let's rack this up. Let's bring this deep dive home with a final summary, really focusing on that idea of being reasonable rather than purely rational.
Yeah, that's a great way to put it, because we're human, right? We're emotional. We're not calculators. So the single best guidepost for any financial decision probably isn't what's mathematically optimal. It's simply, does this help me sleep at night?
Aim for reasonable, not rational.
Exactly. The strategy that looks perfect on a spreadsheet, maybe leveraging up to the hilt when you're young, might be psychologically impossible to stick with when the market drops 50%. You'll panic and blow up the whole plan.
So the best strategy is the one you can actually stick with.
For the long run, for decades. That means prioritizing survival, maximizing longevity in the market. It means finding humility when you win and compassion for yourself and others when things go wrong, respecting luck and risk, and always, always increasing your time horizon.
And using money primarily to gain control over your time.
That's the ultimate prize. Avoid those extreme financial decisions. Your goals will change over your life. Your desires will change. You don't want your future self trapped by a decision you're younger, less experienced, maybe more ego-driven past self-made. Keep your options open.
And finally, let's end with that powerful story about the alien observer. It really nails the invisible force driving everything.
It's such a profound image. The alien flies over, say, Times Square in 2007, sees the buildings, the tech, the people. Then it comes back in 2009.
And physically, nothing's changed. Same buildings, same technology, same smart people.
Exactly the same tangible stuff. But the stock market is worth half as much, and 10 million more Americans are unemployed. Why? What changed?
The only thing that changed was the story.
The stories we told ourselves about the economy, about the safety of mortgages, the wisdom of bankers, the future. When those collective stories, those beliefs suddenly broke.
The real-world consequences were devastating, even though nothing physical had changed.
It shows that stories, the narratives we believe about risk, about opportunity, about fear and greed, are arguably the most powerful force in the economy, more powerful than interest rates or GDP figures.
So the ultimate takeaway from the psychology of money is
That mastering money isn't about mastering finance. It's about mastering yourself. Managing your own psychology, the story you tell yourself about what truly matters, what's enough, what's worth risking, and the real power of patience that is the highest financial skill.
a powerful thought to end on. This has
Yeah.
been fantastic, really digging into these ideas.
My pleasure. It's such important stuff to think about.
Absolutely. Thanks for joining us on the deep dive.